Welcome to episode 2 of the Tax Smart Daily, a daily video series for real estate investors exploring tax topics to help you save money and keep you out of trouble. I'm Brandon Hall, managing partner at a firm working nationally with real estate investors on tax and accounting issues. Before we get started, I invite you to subscribe to our YouTube channel so that you get notifications whenever we drop new videos, and also check out the Tax Smart Real Estate Investors Facebook group and the Tax Smart newsletter. Links to those are in the description. Lastly, if you have any questions or if anything that I say resonates with you, please leave a comment on this video with a timestamp. I love interacting with our community. Your comments and feedback are my oxygen, and it means the world to me. Today, we're talking about preferred returns. Now, when we talk about preferred returns, we're typically talking about real estate syndications. And a real estate syndication is when I pool investor money to acquire larger assets or more expensive assets. So maybe I've identified a $10 million apartment complex and I only have $1 million, but I need $3 million to actually buy the $10 million apartment complex. So if I only have $1 million and I need $3, then I need to raise $2 million of investor capital to collect all this, to pool this money to then go buy the $10 million apartment complex. That's called a syndication. I'll go out to my friends and my family, my network. I'll raise this capital maybe in $50,000 tranches or $100,000 tranches, and I'll pool the $2 million so that we can collectively have a $3 million to go and acquire the $10 million apartment complex. But when I do that, I have to tell these investors how I'm going to share profits with them. And that's where a preferred return comes into play, because a preferred return is the person that gets paid first in a deal. So if I'm an investor in a deal and I put $100,000 into a deal and it offers a 6% preferred return, I'm going to get that 6% preferred return before anybody else in the deal gets paid out. So preferred return is beneficial for limited partners because it's some assurance that they know that they're going to get paid out first before anybody else gets paid out from the profits that the deal makes. And for the general partner, it helps attract limited partners to the deal because they can sweeten that preferred return. They can make it 8%, 10%. They can make it higher to entice a limited partner to come into the deal with them, because it's a little bit more assurance that this limited partner is going to be paid out before, again, anybody else is paid out. Now, you'll see a preferred return in the operating agreement whenever you're looking at any of these deals. And it's always going to be a waterfall. So there's going to be a profit and loss allocation in the operating agreement. And the preferred return, the way that it's going to work is it's going to say, first, we're going to pay the preferred return of X. Then we're going to pay any excess profits, 70% to the limited partners, 30% to the general partners. And then once we hit some internal rate of return hurdle, we're going to make any excess profits in addition to that, split 50-50 between the limited partners and the general partners. You'll see something like that. But the important thing is that the preferred return comes first. Now, the issue, the tax issue, I should say, is that preferred returns that are based on unreturned capital contributions are called guaranteed payments. In Treasury Regulation Section 1.469-2E22 treats guaranteed payments as interest. Now, before we get into what that means, what am I talking about when I say unreturned capital contribution? If I put $100,000 into the deal and I haven't received any distribution, then the preferred return is going to be based on that $100,000 if it's based on my unreturned capital contribution. So maybe it's 6% based on the $100,000, $6,000 a year. If you're the general partner and you distribute $20,000 to me, now my unreturned capital contribution is $80,000. So now my preferred return of 6% is only based on $80,000, my unreturned capital contribution. The issue is that when a preferred return is based on capital and not based on the project's performance or the entity's performance, meaning profits, then that preferred return is a guaranteed payment for the use of capital and it's considered interest. Now, in theory, this makes sense, right? It's effectively I'm going to get paid regardless of how the entity performs, and that sounds a lot like a loan. So that's why it's characterized as a guaranteed payment and treated as interest. Now here's the second issue. The second issue is that IRC Section 469E1 Cap A excludes interest from being able to be offset by passive losses. So if I'm a limited partner in a deal, I put $100,000 into the deal, I get a 6% preferred return based on my unreturned capital contributions. It's a $6,000 guaranteed payment. At the same time, the deal produces for me, it allocates to me an $80,000 tax loss thanks to depreciation. My K1 is going to show a $6,000 guaranteed payment and an $80,000 loss. The $80,000 loss is passive, but it cannot offset the $6,000 of guaranteed payment coming from the exact same source. That $6,000 of guaranteed payment flows through to my 1040. It's treated as interest, taxed at my marginal tax rates. That's the issue with preferred returns that are based on unreturned capital contributions. Now, if you're hearing this for the first time and you're like, wait a second, I have preferred returns based on unreturned capital contributions, either if you're on the LP side or the GP side, go look at your K1s. Oftentimes we find that accountants just lump the preferred returns right into the net loss that's produced. And that's incorrect treatment on preferred returns based on unreturned capital contributions. It should be listed separately as a guaranteed payment, and that guaranteed payment should flow through to your 1040, cannot be offset by the passive losses created by the same deal. How do you solve this? So obviously that's not ideal, right? Like I don't want to have a limited partner come into the deal and offer them this really nice preferred return, and then they turn around and find out that they have to pay tax on that preferred return, even if the deal lost money thanks to depreciation. That's not an ideal situation. So how do you solve it? Well, the only way that you can solve this is to make the preferred return based on performance. So if the preferred return is based on capital, then the preferred return is always going to be treated as interest. You're always going to be paying tax on it. It's always going to flow through to your 1040, and it's always not going to be able to be offset by passive losses. That is true. So how do you get around it? You base the preferred return based on some performance. Maybe you only pay the preferred return when the entity produces positive net operating income or net taxable income. Or maybe the preferred return is a percentage based on net operating income. Or maybe you don't even have a preferred return. Maybe you just play around with your waterfall a little bit to allocate more profits to limited partners in years of positive income or when a capital transaction occurs. But the point is that if you have a preferred return that's based on capital and not based on the entity's performance, it is treated as interest. Section 469 says interest is not from a passive activity, which means that you cannot use passive losses to offset the interest income. Thanks so much for watching today's episode of the Tax Smart Daily. Please check out our Facebook group. We've got links below in the comments. Follow us everywhere online. And if anything resonated with you today, if you have any questions, drop a comment. I'd love to interact with you.